battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to another episode of the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 43 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. It's episode 145, your Lyin eyes. We got producer Owen in the saddle. Welcome back, buddy. We got a great show lined up for you today. And you may have noticed a little difference here with the studio. We rearranged a few things. We got the bookshelf. We got the mobile oil globe. Pretty neat stuff. So we're trying to make the show a little bit better each and every time. Keep coming back each and every episode to get the clarity, the confidence, the good news, the reasons, math, statistics, why you got to stay on your plan. That's what we're doing here on the show. And I will tell you, please, if you can, subscribe on YouTube, Apple, Spotify. Would mean a lot to us, helps get the show to more and more people. Thank you if you already have. Subscribe, share it with your friends and family. Why? Because I'm telling you, there is a time quickly approaching where the media, the doom and gloomers are going to come out of the woodwork like they always do, like zombies coming to get you to sell your stocks. They're going to be walking very slowly and then very quickly, all of a sudden, moving like The Walking Dead, if you know The Walking Dead, and they're going to try and get you to panic. Your job is to stay on your plan, not to panic. And if you're going to have a hard time doing that, like a lot of us will, then you need to have an advisor. You need to have the clarity and confidence, the reasons why you should be on your plan. So that's what we're doing here each and every week. Two big events coming up very quickly. April 17th at Gibson's in Oak Brook. April 17th. Don't miss it. Get it on the calendar. I got a couple spots left for you. If you're in Illinois and you want to come see us April 17th, don't miss that. We got a stack lineup, live podcast on stage with Jeremy Schwartz, who was Dr. Siegel's star student at the Wharton School at Pennsylvania. Don't miss it. April 17th at Gibson's. Got a couple spaces left. And then unfortunately, the 24th, True Lux at the Woodlands, completely booked. We're at max capacity. So if you didn't get on that one, stay tuned for the next event we do in Houston. We'll have to catch you next time. For all of you who are registered, can't wait to see you. So April 24th is full. April 17th got a few spaces left. All right, episode 145. I want to welcome you to 1984. We are officially living in a dystopia. And you are thinking to yourself, wow, I read 1984 by George Orwell, and the government was making up numbers. They were faking everybody out. Nothing was real. Language was not real. Everything was fake. It was a backwards universe. And here we are. It's 2024. We're back in 1984. And the reason why is because we are living with a government that is faking the numbers. I'm telling you, I've been looking at the research that comes out. I've been looking at the data, the Federal Bureau of Statistics and all the stuff that's been released. And I try to square the data with reality and what's really going on, and it just doesn't match up. We have super duper CPI, the made up number that's trying to make inflation look better than it really is. And oops, it made it look worse than it really is. So that's a big L for the government. I'm not just talking about the Democrats. You know, I try to stay right in the middle, call balls and strikes as I see it, because sometimes we get some big government Republicans who are just as bad as the Democrats. All we want is smaller government. We want the government out of our day-to-day lives. And if we get it from a Republican, great. If we get it from a Democrat, fine. But both sides of the parties now are all about how do we make government a part of every aspect of our lives? How do we stomp out the individual, which is the boot on the face, as you'll recall from 1984, all about big government, all about how the individual is not important. It doesn't matter. Language isn't important. Trying to rewrite our words to confuse everybody. And I believe that's where we're going today. We're in a world where the government is trying to make up numbers to make themselves look better. If you're like us and you open your eyes and you go into the economy and you just use a little common sense, you're like, I don't know where they're coming up with these decreasing inflation numbers. Everything I see Food is still expensive. Housing is still expensive with no sign of slowing. We're also seeing the labor market still incredibly tight. I do think there's some softening there. And you saw the government produce number on labor, I believe it was January, where they said we gained like 250,000 jobs. They came out and revised that the next month and said we lost 250,000 jobs. I'm not sure how you have a 500,000 swing unless you're really bad at math, which, you know what, they are politicians, so that could be part of it. But I would say there's maybe a little cooking of the books going on. So again, we'll keep monitoring this. All the implication is for you as an investor is believe yourself. Get out in the economy. Like Groucho Marx said, who are you going to believe, me or your lying eyes? You got to see it for yourself. You got to see what's going on. I still think the consumer is very strong. I still think that people are spending money. I also think that the job market is not as good as some might suggest. I have ran into many people who are having a tough time finding work. I've run into many business owners who are cautious right now, and they are just holding off. They're going to say, you know what? We've got cash on the balance sheet. We're not taking on too much debt. We're waiting for a downturn. And there's enough people doing that where it's good from the standpoint that we're managing risk. And this is the big difference. You know, I'm not a doom and gloomer. I'm not a sky is falling, chicken little, run for the hills guy. But it is good from the standpoint that all of the prepping, all the doom and gloom prepping, doomsday prepping is going to soften the blow when it comes, because you know there's a correction coming. You know there's some sort of a downturn coming. The big question is, Nick, when's it going to happen? So what I've done is I brought back the crystal ball. You haven't seen the crystal ball in many episodes. I got it out of the basement. Oh, man, that's heavy. And I did dust it off. It's back. The question is, what's going to happen? When's the correction going to happen? Well, if we knew, if we could consult the crystal ball, we would find out. We'd say, hey, the market's going to go down on this day, and then it's going to go back up by this day. So let's short and buy and sell and know when to get in and know when to hold them and know when to fold them. But the reality is nobody knows that. This is a crystal ball that I bought from Amazon.com. So far, has not really helped us out at all. So I will tell you, nobody has a crystal ball. Nobody really knows when a correction is going to happen. We know it's coming at some point. So we've done the prepping in the portfolio. We've done the work to make sure we're diversified. We've got risk management in place. We've got some treasuries on the sidelines. So when the correction happens, we can come in and buy on the cheap. But the idea of trying to time the market and trying to get in and get out and trying to figure out if maybe I can go into gold and cash and then I'll go back into stocks when things look better, it doesn't work. There's nobody in history who's been able to consistently time the market. And if you get into that game, you may be right on the way out. But the problem is you have to know when to get back in. And in my experience, that's what nobody can do. Nobody knows exactly when to get back in. So they'll sell when the S&P is at 5,200, and then they'll end up buying back in when the S&P is at 5,400. And they're patting themselves on the back saying, look at me, I got out of the market. Yeah, but you got back in and bought at record brand new all-time highs, because guess what? Every time the stock market corrects and goes down, those people who panicked and got out are saying to themselves, oh, I knew it was coming. It was coming at some point. I called it. I'm a genius. And then it goes down a little more. And when they should be buying and adding to equities, they don't, because they say, oh, they double down, confirmation bias. And they say the market's this is just awful. This is just terrible. I'm happy with my cash. Then things get a little bit better. Stocks go back up. Economy looks a little bit better than people thought. And the market goes up quickly. Remember, it's like 5% up one day, and then you miss the first leg. The people that see that first 5%, they go, oh, well, you know what? That's just a fake out. And we're going to go back. We're going to have a double dipper, going to go back to the lows. But that usually doesn't happen. Usually stocks correct pretty fast. And then all of a sudden you're back to where you started. And then they say, well, I'll wait for the next correction to happen. And then they, of course, don't get in because they're waiting for another correction. And that's why they buy in at brand new all-time highs. That's actually how it works. You may think you can outsmart that. You can say, Nick, I understand people have made mistakes in the past. I'm not going to make the same mistake. Okay, good luck. I've never seen it work for anybody, but you know what? Maybe you can do it. I certainly can't. I know a bunch of really smart people that also can't. Maybe you can. Best of luck. My advice is stay the course, stay on a rebalancing plan, take some profits when things get hot, reinvest the profits and stuff when it's down. You'll be fine. You're going to make money over time, but it's just a more consistent, the tortoise wins the race approach. And if you do that, you'll be fine. I've seen people make 50% in a year and then lose 60% the next year. Is that the kind of return you want to have when you're retired? I don't think so. That's certainly not what I want. I want a nice, consistent, steady return. And maybe I miss a little bit of the excitement on some of the stocks, the meme stocks and the Bitcoin and all that stuff. But that's okay. I know I'm going to be okay with my blue chip US companies that are just plowing forward. So that's my advice. We're going to have a correction. But the problem is what happens if markets get inflation wrong? The stock market is probably pricing in 3 cuts this year, which is maybe a little aggressive. I don't know. I mean, again, I go to the crystal ball. I say, crystal ball, please tell us, how many rate cuts are we going to have this year? I get silence, no answer, nothing, just, no answer from the crystal ball over here. So who knows how many rate cuts we get? And anybody who tells you that they know exactly how many rate cuts we're going to have has no idea. I don't even think Powell knows. And so if Powell himself doesn't even know how many rate cuts we're going to have, how could anybody else possibly know? The market is pricing in 3. If that doesn't happen, if we don't have 3 rate cuts, that's when corrections happen. But my concern is not with the stock market. When a stock goes down, if it's reasonably priced, it comes back. But a bond, if it's a long-term bond in particular that a lot of people have piled into, that they said, oh, this trade is too easy to ignore. My experience, when it's too easy to ignore, that's when you can run into problems. So my advice on the bond market is stay short term. If you can get 5.25% or 5.5% on short-term money, 30-day bonds, why in the world would you ever go take risk and buy a 10-year bond that pays 4%? That's called insanity. Don't do it. Don't do it to yourself. Don't make the same mistake that Silicon Valley did, Silicon Valley Bank did in March of 2023, and all these other community banks that believed the Fed. And this is why I keep saying, question the government, question the numbers that are coming out, because the government was the exact people that said, Powell and Janet Yellen are the people who said inflation was transitory in 2021. And if you listen to them, if you believed them hook, line, and sinker, you got toasted on your long-term bonds. You got toasted on the meme stocks. So you got to question the narrative. The government is going to tell you what they want to tell you to make the president look better. And it goes for both sides. It's Republican and Democrat. But the reality is you have to go out yourself, open your eyes, have the eyes to see what's actually happening. If you're seeing those restaurant bills, I go out to eat, my wife and I go to breakfast, $60 for 2 people for breakfast. We almost fell out of our chair. We couldn't believe it. So you see that and you go, how is the inflation slowing? Or you go to the grocery store, $120 for 2 bags of groceries the other day at the local store. And we didn't even get steak or lobster or anything. We just got like basic sandwich meat and some salads and stuff like that. So you look at it, you open your eyes for yourself. And I think you're going to find that the narrative may not match up with reality. The bond market will crush you, at least in the stock market. You've got the possibility of the companies coming back. So this is why we have long talked about don't just buy anything and everything, cross your fingers and hope it works out. What we want you to do is insulate yourself with good companies. And it doesn't completely isolate you from market declines to own good companies, but it can insulate you when you buy a stock that has a high quick ratio, for example, so they can convert their cash quickly and pay off their debt. They don't have a ton of debt. They have enough assets to cover their debt, for example. Again, that company could have a downturn in a market correction, but it doesn't necessarily mean they're going to go out of business. And that's what you're trying to guard against in stocks is total loss. Now, out of 50 companies or 100 companies in your portfolio, you could have a stock go to zero easily. I mean, we've had a bankruptcy about once every 30 years in the portfolio. It happens. Not common, but it does happen. But if it's only 0.5% of your portfolio, you get back up, dust yourself off, and move on like nothing happened. The problem is if you take 20 or 30% of your portfolio and put it in one stock, that's called bad risk management. That's called not using common sense and exposing yourself to risk you don't need to expose yourself to. Have a risk management process. There's got to be a certain amount you're going to expose yourself to on a security level or on a sector level, okay, or an industry. And so in 2013 and 2014, when people were piling into midstream stocks, and it was the U.S. energy boom, which I love. I think it's great. We need more of it. I'm going to touch on it in 1 second. The problem is you can't put 40% of your portfolio in energy stocks. Are you nuts? I mean, come on, you can't pile into one sector like that. Same thing during the 90s. You're telling me you want to have 60, 70% in tech stocks, which a lot of people did. There's advisors that we were friends with in the 90s who did that with their clients' portfolios. Well, guess what? They're not advisors anymore. You got to have a process. You got to have rules. You have to have guidelines, and you got to know when to get out of the casino. You got to know when to take a profit, and you can't go broke doing that. You cannot go broke taking a profit. You may say, hey, why would I sell my winners and buy some of the ones that haven't done as well? Because that's called math-based rebalancing, rules-based rebalancing. You got to know when to go home and take your ball with you. You can't always just say this stock's going to go up forever and it's never going to go down. Sometimes it makes sense to trim some off. So that's what we're actively doing right now. Most likely we will process a spring rebalance. I'm thinking we'll see what happens here. We'll see how things go with the data, but we probably do a spring rebalance. And then of course, you all know, if you're our client, we do the November rebalance. And that is a wonderful time to reorient the portfolio for the new year. Now, I want to talk a little bit because I went to that CERAWeek thing. I stopped by. I didn't go to the conference, but I did stop by, said hi to a friend. That's the big energy conference, industry standard CERAWeek in Houston. 7,500 oil and gas executives from all across the world in Houston for a conference to do what? To talk about how do we get the world to a better place. And the question is, what does better mean? And I think if you ask various people, you ask the John Kerrys of the world and you ask the Greta Thunbergs or whatever, what they think, better means that they get to go fly around in their private jet, but you have to stop using your toaster at home. That to me is not better. And if you ever question these people about, hey, how come I can't have a cow? And they're going to tell you, you can't have your cow because it farts too much. And you can't have chickens, but we're going to consolidate all the food and energy, and we're going to have control over everything over here in Davos. You should start like having your antennas go up and saying, wait, what did you just say? Let's go back to that for a second. Because if I recall correctly, you all are showing up in those private jets, living on the coast, living in $50 million houses, and then you're telling the rest of us that we can't do anything. That to me is about control and power consolidation. It's about communism more than it is about actually making the world better. If you actually wanted to make the world better, you would let the U.S. entrepreneurs and the U.S. energy producers who are on the cutting edge of bringing down emissions. We are the #1 contributor to the reduction in global emissions in the U.S. Why? Because we have some of the cleanest energy. We have the top minds working on it. And look, none of us want to walk outside and have it be like smoking 3 cartons of cigarettes. None of us want that. There's not a single person on earth who wants to live in a dirtier world. But what we disagree on is how are we going to get there? Are we going to give all of our rights in the name of climate change and climate emissions to Davos, to a small group of concentrated people, which a little scary, sounds like Marxism, because it is, or are we going to do it through the entrepreneurial efforts that we've always done through in this country? This country, the United States, we believe in the entrepreneur, in innovation. That's how we're going to get to a cleaner place. And so what I see when I talk to my Exxon people, you see the globe in the background here, or our Chevron or Conoco or whoever you're with, I talk to the researchers, the MIT grads, the PhDs. It's incredible. These people are fascinating. And what do they do all day long? Why do they go to work and get up in the morning? Because they really believe that they can make the world a better place, but they're doing it the right way. They're doing it through the entrepreneurial innovation way. And that's what we got to have. We've got to have entrepreneurs lead this energy transition that is coming, but we do have to have it led by many people, by companies, by competition. We can't have it all consolidated in a small group of hands. That's where you should just get absolutely scared out of your mind when you're seeing Klaus Schwab talk about how we're going to have a great reset. Yeah, great reset. What does that mean? It means that everybody else is poorer and the small group of 50 rulers is richer. Again, sounds a little bit like communism to me. You can't go down that route. So let's move on. How do you do it in the portfolio? And this is what I've told you consistently, is you got to be careful what you buy and what you own. The days of owning anything and everything, putting it into a target date fund, for example, is an absolute disaster. And if you did that, if you put your money into one of these target date funds that has 30% in China, Europe, and Japan, and then another 20 or 30% in long-term bonds, your returns the past 5, 10, 15 years have been abysmal. So what we're looking for instead is high quality companies. I would call it growth at a reasonable price. That's GARP. A lot of people talk about GARP, growth at a reasonable price. That's a good way to look at it. High quality. What does that mean? Strong balance sheet, lots of cash, low debt. We want free cash flow. We love cash. We're investors in companies. What do we love? Free cash flow. We want to see how much money are you making from operating profits? Are you growing those earnings? Are you growing those profits? And so what I do is I run a screen on all U.S. companies. There's 8,277 of them total. And then I filter by which ones are profitable. They're growing their profits and growing their earnings any amount. Well, it turns out that there's about 1,089 of those. So about 13% of 8,277 are actually worth looking at. Then there's 506 that have good balance sheets out of those 1,000. So you go from 8,000 to 1,000 to 500, only 6% of companies that fit that criteria. And as you go down the list, we love the mega caps, the large caps, because of the Matthew principle, Matthew 25 in the Bible. The big get bigger, the small get smaller, go out of business. And what we do is we say, okay, who are the mega cap names? Well, out of the 8,277 that gets narrowed down to 500, there's only 20 names that are actually worth looking at in that mega cap group. The two highest ranking, according to those criteria, are NVIDIA and AMD. And none of this is stock advice. Please don't hear me wrong. I'm not telling you to go out and put your whole portfolio in NVIDIA, but I'm just trying to give you an example. NVIDIA has been this incredible stock the past 5 years. Why has it done so well? Not just because of a Fugazi, a Woozy, a Wazi, like Wolf of Wall Street. It's fake. It's not real. It's going to crash, which NVIDIA could correct. We all know that's going to happen at some point. But the reality is NVIDIA stock is up because it fits all these criteria. It's a high quality company. It's got a great balance sheet. It's got great earnings. It's growing profits, growing revenues, and they've got a lot of cash. They've got a great business model. So it's not a bad company. It's not fake. It's based on fundamental real data. Now, do you go out again and put your whole portfolio in NVIDIA? No, you have an allocation to it, a small little weight, and then you rebalance along the way. Now, if I go into the large cap names and I go out of that 506 companies, there's 158 that fit the criteria in the under 200 billion in market cap space. And the highest ranked name there is ConocoPhillips. So again, it's not about putting all your portfolio in Conoco. It's not about, I'm not giving you buy or sell recommendations. All I'm trying to tell you is there's just not that many companies out there in the 8,300 stock universe that really fit our qualifications. And that's why you have to be smart about what you're doing. See, mid caps are also a problem. And I've told you mid caps and small caps can be a risk. Why? Because there's just not that many good ones to buy. And then it comes down to security selection. And in my experience, it's very hard to select the right securities consistently over the long run. You do not want to try and become a stock picker. And what happens with that is there's 18 names in the mid cap universe. There's like 20 in the small cap universe. You got to pick them perfectly right. And if you don't, you lose money or you don't make any money. So that's why we focus on the top names. There's not that many good ones. You got to be in the top 50 is my opinion. And that's a good way to filter out the garbage. Let's talk international. So just like there's 8,300 companies in the US, there's 1,200 companies internationally. Out of all 1,200, only 20 of them meet the same criteria, and only 3 of those 20 are large caps. Alibaba, Icon, which is a healthcare company in Ireland, Genmab, which is a biotech, not sure if I'm saying that right, in Denmark. So the question you have to ask yourself is it really worth all the regulatory, political, and economic risk to go out and look at these 3 companies? My opinion, I don't know. And again, I'm not telling you to go panic and sell your Alibaba stock. I certainly have not bought any. I'm not buying any for clients. Thank goodness. We've avoided the disaster that China is the past 5, 10, 15 years. But really, you really think that a Chinese entrepreneur in China, on mainland China, Chinese soil, is going to be more motivated than a U.S. entrepreneur? Hard to say. I'm not saying that the Chinese people aren't innovative and smart. In fact, they're some of the smartest people on earth, but they've done it in the United States. Same with the Europeans. There's plenty of brilliant Germans and French and Spanish and you British and all these people, but they're all in the United States and they're innovating here. Same thing with the Indians, same thing with the Africans. They're all here. We have a melting pot of the best minds, the best talent, the best thoughts on earth. You got to be here in the US. That's my opinion. So here's the results the past few years. It's all in the numbers. You can hide behind everything else. You can't hide behind the numbers. US, the past 5 years, up 15% a year. Europe, up 8%. China, negative 6.6% per year. Japan, only up 7.2%. Now, here's the 10-year numbers. US, up 13% a year. Europe, up 5% a year. China, up 6.6%. I'm sorry, up 0.85 the past 10 years. Japan, up 6.5% the past 10 years. The U.S. is double any of these other regions. Here's the 15-year numbers. 15% each year in the U.S. for the past 15 years. Europe, up 9% a year for the past 15 years. China, up 5% a year the past 15 years. A treasury would have done better. Japan, up 7% a year the past 15 years. So where do you want to be? Do you want to be with the losers over here that can barely innovate, that can barely produce profits, that don't have the rule of law and personal property rights? And again, I'm not saying the people are losers. I'm saying the companies have not been able to compete with the U.S. companies. The companies here in the U.S. are the winners. So are you going to double down on the losers or double down on the winners? My opinion is you want to be with the biggest and the best. That's why we want to keep you in the U.S. Let's wrap up on one thing, and that is the fact that everybody says the world is coming to an end. Everybody says that, oh, in 10 years, the market is going to come down. We're going to have a good 5 and then a bad 5. We're going to have a big collapse. We're going to have a next Great Depression. Just remember, if you put on a tinfoil hat and go talk about how the world is coming to an end and you're predicting that in 2032, the world is ending and you should buy a bunker and fill it with gold and canned food, we would always ask the question, what are you selling? And in my experience, what's happened is the people that are talking about this, that are saying the world's coming to an end, are trying to sell you an umbrella, or they're trying to sell you a bunker, or they're trying to sell you canned food or gold or silver coins or inflation protection, whatever that's supposed to mean, or an annuity, God forbid. And what's happened is people have made emotional decisions. They haven't thought through what they're really doing. And if you sell your stocks, what you're doing is simply selling your ownership in the best U.S. companies. You're taking all of your equity ownership in Apple, Microsoft, Amazon, Google, Netflix, Procter & Gamble, ExxonMobil, United Healthcare, and you're giving it to somebody who's going to knock you over the head with 6% or 10% or even like an annuity, 12 or 14% in fees. That's literally what they cost to go buy yourself protection from something that just doesn't happen a whole lot. And so the reality of what you have to ask yourself is, do I want to be a timer, a Chicken Little run for the hills, sky is falling person, or do I want to align myself squarely with human nature? Human nature, the optimistic U.S. human nature, human spirit, is to grow, to innovate, to make the world a better place. And I would argue very strongly that 10 years from today, the world is going to be better than it is now. And I believe stocks will be higher. I believe companies will be more profitable. I believe that life will be better. I think people will be living longer. And the reason why is because, and I said this a few weeks ago on the show, I think ideas, not capital, but ideas come from God. And I really believe entrepreneurship, innovation is a miracle that God gives us to make our time on earth a little bit less miserable. And just think back to the 1800s or the 1700s or the 1500s, how we used to struggle to just build a house, and we didn't have cars, and we didn't have good health care, and we didn't have any of that stuff. And I think what we have today is we've just had a miracle of innovation that's happened in the United States, thanks to the rule of law, thanks to personal property rights. And the one threat to that is bigger government. So as you approach this election season, I would encourage you, whether you're left, right, center, you're purple, blue, red, whatever spectrum of the political world you come from, I would just encourage you, to vote for less government, vote for smaller stomping out, for less of the big government policies that have stomped out the individual. And I would encourage you, vote for what you think will actually bring the individual back, that will bring communities back. We used to do everything in this country on a community basis. It was all about your church and your family and your friends, and helping people out that you knew in your community. That's what we always used to be about. And that's what we should want to restore. And I will tell you, I think a lot of us want the same things. I think the media would love to divide us. They'd love to get us hating each other because of our skin color, or because of our political beliefs, or because of all these factors that really, at the end of the day, don't matter. And they want to get us to hate each other. And I think the important thing to do here is to come together on the things we do agree with. Most of us kind of want the same stuff. We want our families to be safe. We want to have a better future for our kids than we do for ourselves. And we want less and less of the big government. We want more and more of the individual, and freedom and entrepreneurship and innovation. And when we get to a place like that, we will restore what I believe is the magic of the United States. I still think we've got it. I'm still optimistic. And the way that the founders set this country up so beautifully, to the point where we've got the checks and balances. We don't crush out the small person. We don't, just because somebody's outnumbered, we don't attack that person. We don't believe in the tyranny of the majority. The way that the country is set up structurally, I think, will withstand a lot of the doom and gloom stories out there. And I think you should be an optimist long run on the future of this country. Thanks for being with us. Episode 145. We'll see you in a few weeks, April 17th and April 24th. April 24th is full. 17th, I got a few spots for you. Don't forget to subscribe to the show. Thank you for being with us. We'll see you next week for episode 146.